Everyone, and welcome to today's webinar titled Crowdfunding Within a Real Estate IRA. My name is Munzer Ghosheh with the Entrust Group, and I'm happy that you're able to join us today. I think you're going to find today's topic to be very interesting, actually, and compelling. I myself am excited to learn more about this new concept out there. And I'm thrilled to have with me as a co-presenter Jilliene, Helman, the founder and CEO of Realty, Mogul. So welcome, Jilliene. Jilliene, are you there?
Hi, I'm here. Thanks so much for having me.
Hey, no problem. How are you this morning?
Fine, thanks.
Great. Thanks for joining us today, again, to educate our listeners. I'm very excited to hear about this extremely new and fun concept here on crowdfunding. So what I'm going to do first to start, I'm going to do a very quick presentation, talk about the Entrust Group and self-directed retirement plans in general, and then hand the mic over to Jilliene for her part of the presentation. I'm sure you'll have a lot of questions out there for Jilliene. So what we'll do is some time for some Q&As at the end of the webinar. So please, at any time, feel free to type in your questions, and we'll try to get to all of them, time permitting, towards the end of the webinar. So let us get started here. Again, my part of the presentation will be very quick, brief, kind of go through about what we do and who we are, talk about a little bit about the self-directed IRAs, and then hand it over to Jilliene. For the listeners out there that are not familiar with our company, we are the premier provider for self-directed IRAs and 401k plans out there. We work with individuals and small business owners and assist them in purchasing alternative investments with their retirement funds. We're one of the oldest and the largest administrators, over 30 years of service, 15,000 plus clients. We administer nearly $4 billion in total assets, as you can see, and all the cash deposited by account holders with us is fully insured by the FDIC. Our staff is very knowledgeable. Most of our staff have earned the prestigious CISP, the Certified IRA Specialist designation, which is highly regarded in our industry. We're also the leaders when it comes to education. We really have a lot of different types of ways to educate our individuals and professionals out there. We offer national CE continuing education programs, whether for realtors, attorneys, CPAs out there, as well as the webinars, as you can see here, plus national webinars that we have, and also very proud of the local offices that we have nationwide that most of them offer in-person events to educate our clients and just individuals out there. So a bit of a disclaimer here that I would have to read out to you here, if you don't mind. The Entrust Group does not provide investment advice or endorse any products. All the information and materials are for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. A little bit about our webinar agenda here, what we'll be talking about. We'll go through the process of using a self-directed IRA to invest in multifamily real estate properties. We'll touch up on why buying multifamily properties offers diversification for you, the differences between multifamily versus single-family investments, working with a property management team, touch up on structuring investments with multiple investors, and then how to performing your due diligence and protecting your investment. Again, a quick bio here on our guest presenter. Jilliene Helman is the founder and CEO of Realty Mogul. Realty Mogul is crowdfunding for real estate, a marketplace for investors to pool money online and buy shares of pre-vetted investment properties or loans secured by real estate. Previously, Jilliene was a vice president at Union Bank, where the majority of her time was spent in wealth management and working with a broker-dealer, registered investment advisor, real estate lenders, and wealth planners. Jilliene is a certified wealth strategist and holds a Series 63. She also holds a business degree from Georgetown University. So, reasons for choosing self-direction. Let me kind of start out by just saying that a self-directed IRA, for ones that are not aware out there, is not a type of retirement plan. It's just a term that we use in the industry for a retirement plan that allows you to invest in alternative investments, such as real estate, notes, private stocks, limited partnerships, and many others. The main reason for choosing a self-directed retirement plan is the flexibility and diversification it provides to you. It allows you to invest in, most importantly, what you know and understand, rather than limit you to just the traditional investments that we most are used to in financial institutions such as stocks, equities, CDs, money markets, and so on. So what can I invest in a truly self-directed retirement plan? Our clients at Entrust actually invest in over 50 different asset classes, and they do get creative. For the most part, and as you might expect, real estate in its different forms, whether it's residential, commercial, raw land, we have clients investing in that, leveraged, unleveraged, even foreign, offshore properties, is by far the most popular type of investment that we see our clients investing in when it comes to self-direction. Other investment options include, and again, this is just a very few, part of it, precious metals, limited liability corporations, secured or unsecured loans, secured in terms of if it's a real estate and it becomes a trustee, joint ventures, and almost anything else that you may think of, with the exception of what the IRS deems disallowable. A couple of asset classes that your IRA may not invest in, namely collectibles, antiques. Your IRA may not be part of an S corp because S corporations are not allowed that. So for the most part, anything else you may invest in. Let me touch up a bit on disqualified persons here. We get a lot of questions regarding real estate purchases with retirement funds on what can and cannot be done, what the IRS deems a prohibited transaction and what is not. In general, a prohibited transaction is any improper use of your IRA by you or a disqualified person. Okay, so for example, buying and selling a property between your IRA and a disqualified person, providing goods and services, facilities to that property, and most importantly, use of the property, living or vacationing at it. All of these things are considered prohibited transactions. So disqualified persons are certain family members that cannot do business with your IRA, and if they do, it is deemed to be a prohibited transaction. Disqualified persons would include a spouse, parents, your grandparents, children, grandchildren, and so on. So anyone that is directly related to you may not do any business with your retirement plan. So in summary, when looking to purchase real estate in an IRA, make sure that there is no self-dealing and the transaction is at arm's length. So now we mentioned, we cannot buy or sell between a disqualified person and an IRA. But these disqualified persons, including yourself, may partner together to purchase a property as long as it's a new deal, as long as you're going out to purchase a property from a third party. And you can partner as undivided interest, joint tenants in a deal. So example of an acceptable transaction would be partnering with yourself and your IRA to purchase a new property, and again, as long as it's purchased by a third party. Partnering with your cousin, again, a cousin is not a disqualified person, so that's whether it's a new deal or not, it's an acceptable transaction. Partnering with your spouse, again, a spouse is a disqualified person, so it has to be on a new deal. Leasing the property to your siblings, ironically, siblings are not considered as a disqualified person, so as long as you're dealing with them as if they are a third party with no and renting them out to fair market value, then there are no issues. It's an acceptable transaction. We also get many inquiries a lot of times on how to structure the purchase of a real estate. Obviously, Entrust does not make any recommendations or give any advice, any type of advice, whether it's tax, financial, what have you. But for the most part, clients are either want to buy the property outright with their IRA or multiple members, again, undivided interest, or set up an LLC or a business trust and have the IRA as a member in this LLC, and then you may go out there and purchase the property that way, titled in the LLC. So if you're doing it through the IRA, the purchase contract must be signed. Purchase contract is in the name of the retirement plan, the Entrust group for the benefit of John Smith IRA number so-and-so, and the purchase contract is signed and by us as a trustee. In this case, all the rents, expenses flow in and out of the IRA, and if there's more than one partner, it's pro rata. In the sense if you want to do it through an LLC, then again, all we do is fund the LLC, and then the LLC is on title, and everything is done in and out of the LLC on that, if that's what you decide to do. In terms of plan types, again, if you recall, we mentioned first that self-directed retirement plans is not a type; it's just rather a term used in the industry. So really, any type of plan you currently have, whether it's a traditional IRA or Roth IRA, if you have one of those employer-based IRAs such as a SEP or a Simple, or even have an individual K, all these types of retirement plans can be self-directed as long as they are, set up with a trustee such as Entrust that allows you self-direction. Getting started, a lot of times, again, we have inquiries of, especially when it comes to real estate transaction, on what is the timeline involved in doing something like this. Keep in mind there are three phases here when we're dealing with setting up a self-directed IRA. One is actually getting the account open, and that takes about 2 to 3 days. We have an account open up for you. Second step would be to fund your account, whether you're funding it through a transfer from a current IRA you have or rolling over from a previous 401k that you have. That generally takes about 10 to 14 days. After that, you're ready to identify the property or the investment you want to invest in, and then we get the purchase agreement, we sign it, and we fund escrow and so on. So that's basically how the process works. So what I'm going to do right now is hand the mic turn over to Jilliene for her part of the presentation, and then after we're done again, we'll take some of your questions, and we'll go from there. So Jilliene?
Thanks for having me on the call today, Munzer, and welcome everybody this morning. I'm going to talk a little bit about how to use crowdfunding to generate passive cash flow from real estate in your self-directed IRA. And I've got a quick disclosure as well. I'm not an attorney or a CPA, so I'm providing information for educational purposes as well. But I am personally a real estate investor. I'm also a certified wealth strategist, a Series 63 license holder, and a business owner. So I think that I have some good context around how to use not only crowdfunding, but also how to use a self-directed IRA and how to get access to real estate investments through it. So before I go any further, I want to talk about what is crowdfunding. Now, maybe some of you have heard the term crowdfunding with the likes of Kickstarter and Indiegogo, and we've applied the concept of crowdfunding to real estate at my company, Realty Mogul. So at its core, crowdfunding means pooling money together from a group of investors to make an investment. In this sense, crowdfunding has really existed for centuries. Neighbors have bought property together, husbands and wives and their sisters and brothers have collectively bought property, and even multiple institutions have come together to collectively purchase property. In the past, in real estate, this was called a syndication. So syndication of the past and crowdfunding of the present. And the major differences between collective real estate investing of the past and crowdfunding for real estate today are really 5 more items. The first one is the ability to transact online. Historically, you had to do a lot of these transactions offline, and you had to have these offline relationships to do these real estate investments. With crowdfunding, you have the ability to transact online through a number of different websites. The second one is unparalleled access to deal flow. So even when institutions were doing real estate syndication or when pools of individuals were coming together, you had to have access to a specific transaction to even see that transaction. So crowdfunding today gives many investors unparalleled access to transactions they otherwise would never have access to. The third point is lower minimum investments. You're looking at $5,000 or $10,000 minimums compared to $50 or $100 or even $1 million or $2 million minimums in the institutional level. At Realty Mogul, for example, our minimum investment is $5,000. The fourth item is 24 access to reporting and money management. Now, real estate specifically is an illiquid asset class. You're typically buying a real property or investing in a loan that is secured by a real property, and there's typically not very frequent reporting on that. So real estate crowdfunding gives you the ability to have an overview and an overlook into all of your investments whenever you want it online, sort of at your fingertips. And the last point is transparency. The real estate market has been a very untransparent, somewhat complicated market because there hasn't been total data flow to and from buyers and sellers. Now, some real estate companies like CoStar and LoopNet and Auction.com have brought a lot of transparency to the market, but my prediction is that crowdfunding is going to bring even more transparency to the market. These transactions are going to be shared with a wider group of individuals. There's going to be more oversight on the transactions, and I think that more transparency is always a really, really good thing for investors. I think the number one person that it benefits is the investor group. So that's a wonderful, wonderful thing. So I want to talk today specifically about passive cash flow in your self-directed IRA. And what that means is that you are not dealing with the hassles of tenants, toilets, and trash. And, sorry, that slide didn't go forward there. Okay, there we go. So I want to help you as an investor avoid tenants, toilets, and trash. And the way that you do that is by investing really in any asset class passively. We're going to specifically talk about real estate today, but you can accomplish this, with a variety of different asset classes through your self-directed IRA, like Munzer talked about earlier. So what is passive cash flow? At its core, earning passive income means you've separated how much money you make from your time. This approach is very different to active income, such as showing up for work each day, where your time and income are linked. And I'm showing an image here of a worker punching into a time clock. As a passive investor, you can literally make money while you sleep. You can have a steady stream of payments coming into your bank account automatically every month or every quarter with little to no effort. The majority of your time is spent up front, conducting due diligence on the investment opportunity and making the decision to invest after understanding the risks. So there are a variety of ways to earn passive income. Here's an example, a savings account. A savings account is a classic example of passive income, but earning 0.01% or 1% on a CD isn't exactly making you a rock star. But we're getting closer. We've got cash flow without a second job, and you've got cash flow earning day or night, whether you're asleep or awake or working or not working. But there's other ways to generate higher returns off of cash flow, and that's where real estate comes in. Real estate has proven to be one of the most effective vehicles for reoccurring passive cash flow. In real estate, cash flow is normally generated when you get income from rent, sell a property that went up in value, or loan out money to a real estate company for interest. And so I want to talk a little bit about the strategies. And I want to talk specifically about two different types of real estate investing through your self-directed IRA and through crowdfunding. And I'm focusing on these because neither requires you to pony 100% of the funds to purchase a property, and they do not require active management. So in the first type of investment, maybe you're investing in an office building, like this one, or a multifamily apartment complex, like this one. In either case, when you're investing as a passive investor and using crowdfunding, you don't own 100% of the building. You just own a piece of it, like the left-hand corner in this image. In this image, you're seeing that there are a variety of investors who are investing in this same property, be it an apartment building for example purposes. That being said, there's similar risk to owning that building outright. And for those of you who have heard me speak before who are just getting acquainted with me, I'm a big proponent of understanding all of the risks and being fully educated before you make an investment decision. So I want to walk through some of the risks and benefits of owning that piece of a building. The biggest risk to your cash flow are that expenses exceed income. For example, maybe the estimated vacancy is 10%, and at 10%, the building cash flows great. If in reality the building experiences a 50% vacancy, so vacancy grows 40% for some unforeseen reason, your cash flow is going to take a deep hit. And that, if your cash flow dips too low, you may not have passive income from that property anymore. So that's one of the big risks. The other risk is that the property declines in value. So maybe the neighborhood goes down, maybe the economy goes down. For some reason, that building declines in value, and you end up losing money as a result. That being said, there's lots of benefits to buying a piece of the property. First off, you get to participate in cash flow from rents and appreciation when the property is sold. If you're buying a piece of property that already has tenants in place, you might even see your first check as early as 1 quarter after you invest in the property when you're investing through crowdfunding. There's also no management on your end. If a toilet breaks, you don't get the phone call. You also own a physical asset. It's not a stock that has a lot of volatility or a bond that may move up and down with interest rates or other indicators, but it's an actual building that you can see and touch and feel. A lot of the wealth across America has been made in real estate, and that's really because it's this tangible asset that can be traded. So that's recurring passive cash flow, and if done right, it'll be much more significant than a savings account. Now I want to talk about the second type of passive investment you can make out of your self-directed IRA, and this is a loan. I'm thinking many of you have seen TV shows on A&E and TLC like Flip This House. But I don't want to talk about you being a rehabber or you being a flipper, because that's a job, and we're not looking for a second job. We're looking for passive cash flow. So you can actually work with these flippers and work with these professional real estate investors to generate this cash flow. And you do this by making loans and quite literally becoming the bank. They're typically called first trust deeds. And it means that you as the investor become a private money source and loan money to a borrower. Your investment in the loan is secured by a document called a trust deed. These deeds are filed at the county recorder's office, demonstrating legal proof that your loan has been made on the property and is secured by the actual property. By recording the trust deed, you're giving public notice to any other lenders or lien holders that you hold a debt on the property. And you're also shielding yourself from the possibility that the property is sold without repayment of the loan because you're recording that trust deed. The loan is said to be in first position because there are no other lenders that have claim to that property before you. Should something occur to that loan, you're in the best position to recover your investment. And you also have title insurance to ensure that you're really in first position. One of the most important factors when making loans secured by real estate is to make sure you have an equity cushion. For example, at Realty Mogul, we don't showcase loans that are for more than the purchase price of a property. There's always an equity cushion in the transaction should something happen to the property or should the real estate markets take a dip. We typically look at loans that are 80% loan to value. And loan to value is also known as LTV in some real estate circles. So the difference between buying a whole loan and doing crowdfunding is that with crowdfunding for real estate, you're going to buy a piece of a loan. So if you have, $50,000 to invest, maybe you can diversify that across 10 or 20 loans as opposed to only buying one loan, allowing for greater diversification within first trust deed investing, which was really, really challenging to get before crowdfunding for real estate. The next piece that I want to talk about is sort of the 4 benefits of trust deed investing, and this is this loan investing. Number 1, there's lower volatility. Unlike the stock market, investing in loans secured by real estate tends to be less volatile. And there's a question that just came in from Frank, which is, what is your return on crowdfunding? The returns can vary widely, and there's always risk with every investment. On our loan investments at Realty Mogul specifically, our returns are typically 8 to 10% on our loan investments. And that's on an annualized basis, though of course that's subject to change, and past performance is never indicative of future performance, but we shoot for 8 to 10%. And it tends to be less volatile than the stock market. The second thing is that it's secured by the property. So when you're investing in stocks or bonds, there's no physical asset that you can see and touch, and when you're investing in trust deeds, you know the exact property that you're secured by. The other is consistent cash flow. On our trust deeds at Realty Mogul, we provide monthly distributions to our investors. And because we're also a technology company that's quite high-tech, we have the ability to deposit that directly into our clients' bank accounts or directly back into their self-directed IRA account. So that money continues to accrue, and it's truly passive income. Now, I touched on this one as well, diversification. But with a minimum investment of $5,000, you can invest in 10 or 20 first trust deeds with a smaller amount of capital than you could before crowdfunding for real estate. So to recap that section, we talked about making 2 different types of investments. One is investing in a piece of a property like a multifamily building where your returns are a little bit more variable, but you get paid cash flow and appreciation. And the other is investing in loans where your returns are more consistent and your investment is secured by the property. Now, before I talk about crowdfunding more specifically, I do want to provide one note about self-directed IRAs and UBIT, or unrelated business income tax. Again, I'm not a CPA or a tax professional, but there is something about crowdfunding your IRA that's important for you to know. For transactions where we're using leverage, like investing in a commercial property where there's also bank debt, it may trigger UBIT, and this would require the IRA to pay that tax. It should not be triggered when you're making loans buy real estate out of your self-directed IRA. And it should also not be triggered if there's no debt. So in first trust deed investing, it's typically not triggered, but if we're buying a $20 million apartment building and putting $14 million of leverage on that property, it may be triggered and it may require a tax filing. I want to chat about crowdfunding now, and what do you actually own and how does it actually work? And I'm going to talk about this, holistically from the crowdfunding industry when investing in real estate through crowdfunding. You're typically investing alongside a professional real estate company with a history and a track record of success. So in first trust deed investing, you might be investing alongside a development company who's done 50 or 100 or 200 rehabs. On the equity side, you may be investing in a company who's invested in $300 or $400 or $500 million of equity investments in multifamily or office or retail. And you're typically purchasing shares of a limited liability company as a limited member. In turn, that limited liability company, or LLC, either owns the loan that is tied to the real property or owns the share of a specific investment property, like that multifamily building. There are other benefits of an LLC, like liability protection, that can shield your personal assets from the investment. And it's very, very similar to a real estate syndication. The main differences between a real estate syndication are that you have the ability to transact online, you have greater access to deal flow, and you have much lower minimums than a traditional real estate syndication due to the economies of scale that the technology provides. Who makes decisions in these LLCs? I've spent a lot of time talking about being passive and what it means to be a passive investor. And decisions in an LLC are governed by a document called an operating agreement. It usually includes managing members and limited members. And the managing members are making all of the day-to-day decisions, while the limited members are passive investors on the transaction. The managing member usually determines things like how much cash to distribute and when to sell the property. So as a limited member, you really are passive. You're along for the ride, and the majority of your diligence needs to be upfront. So when you're looking at the property and deciding if you want to invest, you need to decide, do I want to invest with this company, and do I want to invest into this specific property? So operationally, how does it work? On most crowdfunding sites, it starts by creating an account, letting them know who you are as an investor and what types of things you're interested in investing in, and then browsing and selecting investments. Which investments are you most interested in? Are you interested in first trust deed investments and making loans out of your self-directed IRA? Or are you interested in making larger equity investments and owning a piece of a $20 or $30 million building out of your self-directed IRA? The third step is to finalize your investment by selecting form of ownership. For example, in this screenshot, you can see that you can select self-directed IRA to start that transaction process out of that account. And from there, we work with a self-directed IRA company, like the Entrust group as an example. The last step is starting to see distributions off of that investment. So you will expect to receive monthly or quarterly payments and updates as an investor in a transaction. Here's an example of what an earnings dashboard looks like at Realty Mogul. And the reason that I wanted to share this was because I think it hits home that point about passive income. It's all about, the money that's coming out. And the consistency around that. So again, we shoot for monthly or quarterly distributions. We don't focus on anything that doesn't distribute cash flow, so we're not in the development business. I think that the risk-reward profile is different for that development versus existing assets with existing cash flow. And we're also really big on diversification. So I think that when you're thinking through your portfolio from a holistic investment basis and also within your self-directed IRA in particular, if you're going to invest in alternative asset classes like real estate, you want to be thinking about diversifying across different properties. So maybe you're doing some single family, some multifamily, some office, different geographies. Maybe you're located in California, in Los Angeles, but you want to get exposure in Dallas, Texas, and Jacksonville, Florida, and Memphis, Tennessee, because these economies and those microeconomies are slightly different. And also the types of transactions that you're investing in. So do you want to diversify across loans and equity? And there's a different risk profile really across all these things. There's a different risk profile within property type, within geography, and within transactions. So another benefit of real estate crowdfunding, and one of the slight differences from syndication, is with a crowdfunding company you can get access to all of this diversification, where with a real estate syndication a lot of times it was one investment into a specific property, into a specific geography. I have another question here, which is what is the typical term of the trustees? So I'll go ahead and address that.
Jilliene?
They can range.
Jilliene?
Typically, for us, we're looking at 1-year trustees. So they're illiquid for that 1 year, but they tend to turn over really quickly. We've underwritten over $400 million of real estate at Realty Mogul, and we've seen everything. We've seen 6-month, 1 year, 3-year, 5-year. Some are fully amortizing, some are interest only. So we see and underwrite a lot of transactions. What we've done to date has historically been shorter-term 1-year trustees. And kind of as my last slide here and as a quick recap, I think there's 4 reasons for passive real estate investing with crowdfunding. The first one for me is no toilets, tenants, or trash. And I'll share a personal example. I've been managing a multifamily building on behalf of my family and our family trust for some time now. And despite the fact that I'm in the real estate industry, and despite the fact that I know the property very well and the property's been in the family for a long time, it's still a hassle. It's a hassle every time a tenant turns over. It's a hassle every time that there's an issue with the building. Our water heater exploded once. We ended up having to have a door removed because one of the locks got jammed up. So it's really a different experience being an active investor versus a passive investor. So I'll share that. The other is leverage the smarts of other people. I'll share another example here. We are working with a company who owns 12,000 apartment units in the greater Texas market. And they have such experience in this market. They know the neighborhood better than, I think a lot of the brokers know the neighborhood. They have other assets in the vicinity. They have property management companies that have economies of scale because they have these other assets. And really we're leveraging the smarts of them, and we're leveraging their network. For an individual to go start up a real estate investing company in Texas or Tennessee or Florida or Los Angeles or Oregon, Washington, it requires a ton of work, and you really have to educate yourself on that market so you don't make mistakes in that market. And I think one of the greatest benefits of passive investing, as a whole, and specifically with real estate crowdfunding, is really that ability to leverage other people's network and leverage their smarts. Number 3 is making money while you sleep. I talked about this when I was talking about the banking and making 1% in the bank. It's no different, but hopefully you can earn greater than 1% and start hitting 8 to 10 or 12 or 15% returns. Doing something that's a little riskier. I mean, of course, investing in real estate is riskier than investing in bonds or investing in the bank. But if you can get comfortable with that risk, making money while you sleep is one of those big benefits. And then the last one is you can do it seamlessly online from the comfort of your own home. At our website, realtymogul.com, we have a couple thousand investors who are investing with us at all times of the day and night. There are people who are on at 3 in the morning, 4 in the morning, 5 in the morning, 6 a.m. It doesn't require me and my team to be awake for our investors to be doing diligence and to be asking questions. And I think that's one of the big benefits of technology and introducing technology to the field of investing and now, having an intersection between technology and self-directed IRA investing. There's one other question here.
Jilliene?
Yeah.
Yeah, can we hold on to the questions until we're done, if you don't mind?
Sure. Yeah, and I think I'm finished. That was the majority of my presentation. I'm happy to take any additional questions here. You can always email my team at info@realtymogul.com or call us. Our number toll-free is up there, 877-977-2776. So we're always willing to help investors. Even if you're not interested in investing today, but you just have questions about real estate in general, we're more than happy to answer those questions. A big part of our culture at Realty Mogul is educating and helping to facilitate this new market opportunity. So we love what we're doing. We're very passionate about it, and we enjoy helping investors of all walks of life.
Great, wonderful. Great presentation, Jilliene. Thanks so much. I think very valuable information. I see a couple of questions, but if you don't mind, a couple of those questions were pertaining to loan to values or returns or what have you. If those could be addressed directly to Jilliene either via call or email, since we'd like to just keep the information purely educational here. So if it's on the specific investment, listeners out there are more than welcome, as Jilliene mentioned, to contact her directly, either email or phone with the information up there as far as the specific information about the investment itself. But I do see a couple of other questions here that let's pose to Jilliene. I actually have one here. I'm just curious. I don't know if anyone else is. You talked about the loan secured by real estate trust deeds. Are yours, Jilliene, for the most part, they're always first trust deeds, or they're second, or just first?
Yeah, so, personally, I only invest in first trust deeds. I think that there's a place for second trust deeds for some investors, but at Realty Mogul, we only offer firsts, and I personally only invest in firsts. For those of you who, need some clarity on what the difference between a first and a second is, it's what position you're in. So if you're investing in a first trust deed, you are in the first position to recoup your investment if there's a foreclosure or some other loss on the property. If you're investing in second trust deeds, there's another investor who holds the first in front of you. So it may be a bank that has a traditional loan and you're investing in the second, or it could be another private investor in front of you and you're investing in the second. Second is obviously riskier than first, and as a result, they tend to have higher returns. But yeah, I don't play in the second world. Personally, within my own risk profile, it's not a fit for me, and we focus exclusively on first as a result.
Great, thank you. And just another, as far as pitfalls, if there's any, I mean, what else could a prospective client need to know about this? We see all the advantages, obviously, but anything they might get themselves into some sort of trouble that you can think of? Yeah,
there are tons of pitfalls. And I, as Rosie and as excited as I am about this industry of crowdfunding, there's a lot of things to watch out for, and I'm sort of the contrarian CEO, if you will, about these things. But I'll share some examples with first trust deed investing and also equity investing. But let me start with first trust deed investing. I talked earlier about title insurance. So title insurance is a big one, and for investors who go to do first trust deed investing on their own, you definitely can do this on your own. You can't buy a piece of a loan on your own. That's really where crowdfunding comes in. But you could theoretically go out and buy a whole loan on your own. What I find is a lot of investors don't have experience doing the title review. And I'll share an example with you. We do a lot of these, and we work with a lot of different title companies, and we see exemptions on title where the title company is trying not to insure against a number of things that have happened historically on the property that really they should be insuring against. And what's happened in title is that these title policies are being automatically generated from a computer system. So they're not a single individual or a human being who's creating these title policies. And so we'll go back into almost every title policy and ask for anywhere between 5 and 10 exemptions to be removed. We have 2 in-house attorneys within our own team who do a lot of this work. But one thing that really scares me is, if you have an investor who's not familiar with that, it's one of the places where you could, get bitten. So if you are going to do this on your own, either get your own counsel or, educate yourself on title policies and all those exemptions that are included in those title policies. The other one is property insurance. So anytime that you're doing first trust deed investing, you want to be named, or the entity that you're investing with wants to be named, is what's called the loss payee. Mm-hmm. So at Realty Mogul, we always make sure that the entity that is holding the collective loan on behalf of all the investors who own the shares in that entity are named as loss payee. And what that means is that if there's an insurance payout, you're going to get paid, as opposed to that real estate company getting paid. Mm-hmm. Your loan is going to get paid out in full first, and then any additional. You can go after a borrower in other ways, but insurance is a big one. The other big one is just legal documentation and personal guarantees. And this comes really big into play if you're going to invest across different states. Mm-hmm. We draft different trustee documents and personal guarantee documents and promissory notes depending on the state that we're investing in. And we've now got some pretty solid docs in the states we're going into. But if you want diversification across a variety of states, it's going to be challenging to get those economies of scale as an individual investor. So those are 3 of the big pitfalls that I see some investors fall into. And really what they end up in is, sometimes it's fine. If the loan performs, you're fine. But what you could end up in is litigation where your docs aren't solid. You could end up in a situation where you have a fire or an earthquake and you're not named as insurance, or you could end up in a title battle where there's someone who claims that they're in first on the property, or there's some exemption that is claimed. So those are some of the pitfalls on the first trust deed investing side. On the equity investing side, I think that the pitfall there is really a function of the market. I mentioned that we've underwritten over $400 million of real estate, and I'm seeing some concerns in the market, particularly in a couple of different places. One of those places being development. I'm seeing a big splash of development right now in locations and areas that aren't showing requisite population growth and aren't showing, requisite demand for that development. So I have a lot of concerns about how quickly development is coming back. And another one of my big concerns on equity is in the multifamily sector. Now, we've done multifamily investments, but we tend to throw away most of the ones that we underwrite because I think that multifamily is overheated right now. Mm-hmm. And I think that there are people who are acquiring multifamily apartment buildings at a 5 cap or a 6 cap. And it just doesn't make sense. It's at the height of the market. So that's a concern of mine. So really, the pitfalls around equity are a little bit harder to define specifically. A lot of it starts to become intuitive, and when you do the underwriting, you start to see them. But another example, when we're doing our underwriting, one thing that we look for is we look for rental growth to grow at a similar pace as expense growth. Mm-hmm. So if you're going to invest in, an equity property with a real estate company on the ground, you don't want to see, incomes growing at 15% and expenses growing at 2%. That is a major red flag to us, and it's something that we see frequently, and we just throw those transactions out. We say, these aren't companies that we want to do business with because they don't think the same way that we do. Mm-hmm. I personally think fairly conservative, very focused on cash flow, very focused on capital preservation. In my personal investing strategy. And for me, that's why we do investments that allow us to generate income, generate steady income, and avoid, a lot of the excess risk. Now, that typically means that you're also avoiding some of the upside. So you have to be willing to forego some upside to minimize some risk. So just understand that, on that sort of risk-return profile, that's a real thing. Your riskier development transactions are going to return more holistically than an apartment building that's 90% occupied.
Yeah, thanks for sharing that, Jilliene. I think what you're also saying is due diligence, and we can't stress that enough with our clients, listeners out there is do your own due diligence when you're going into any type of investment. So, thank you. We have a couple of questions. We're kind of running out of time, but. Steve has a question that I think you addressed, but if you want to real quick kind of clarify the differences, Steve is asking, is this a syndication?
So crowdfunding and syndication are very, very similar. Syndication means pooling money together, and crowdfunding means pooling money together. I think that the big differences are crowdfunding is going to be delivered through the Internet as a distribution vehicle, where syndication was typically always offline through personal relationships and sort of having to know a guy. One thing that my partner says at our company is, you don't have to know a guy anymore if you know us. We are your guy. And in that capacity, it's similar to a syndication, but different from a syndication because there's lower minimum investments. So I know a number of syndications where the minimum investment is $200,000 or $250,000. With crowdfunding, you're going to see minimums like ours at $5,000, which is very, very different, and you can use the economies of scale around technology to do that. So similar concept, a little bit of a different delivery vehicle.
I see. Thank you. George has another question here. Do any of the investments qualify for a 1031 exchange?
So it depends on the investment. We work with some real estate companies that can allow for 1031 exchanges, and they're structured, just so you understand from a structural perspective, if you want to do a little more research, as Delaware statutory trusts. They're called DSTs. So there is the ability to do that, but for us, for example, we don't offer that on all of our investments. There's a lot more overhead involved in it, so it would have to be a bigger dollar amount, probably $250,000 or $500,000 to structure a DST for it to make sense from the regulatory and the legal abilities. I'm not sure about 1031s through a self-directed IRA, though, Munzer. I don't know if you have some information on that, but I'm not sure about that.
They're both inherently tax-deferred mechanisms, so anything you do through a self-directed IRA, you can purchase real estate and then turn around and do whatever you want going forward. So they're both inherently tax-deferred mechanisms. We have a couple of instances where one has used their self-directed IRA to do an exchange. It could be done, but typically not. Yeah. Well, question for me, I guess, real quick. I can answer that. Steve was asking, do you have a replay for the presentation? All our presentations and webinars are archived on our learning center at the entrustgroup.com. So yes, you're able to listen to that at any time. I think we have a question, maybe just time for one more question here. Mike is asking, what opportunities are there for accessing crowdfunding capital to finance the purchase and renovation of residential housing?
Lots. That's one piece of our business is that we will lend against residential housing that is going to be renovated and then resold, either renovated and resold or held for the long term. So there's definitely opportunity for that. It always depends on the appetite of investors. Do investors want to be investing in single-family residential, or do they want to be investing in office or retail? So that's kind of a supply and demand question, but there's definitely opportunities for that. I mean, I'll share another example. We recently closed on a pool of 10 loans. They were in Memphis, Tennessee, and all 10 of the loans are going to be renovated and then resold. So we wrote one-year trust deeds on them. We're in first position, property insurance, title insurance, and we have personal guarantees on it all. But there's opportunities to finance a single property, and there's also opportunities to finance pools of property, whether you're acquiring them or whether you already own them. One of the interesting things about crowdfunding is because we have technology, we have the ability to do things on a more streamlined basis. So there's opportunity to finance a variety of different transactions.
Great. These have been great questions. Unfortunately, we are running out of time. We're actually a bit over, but that's okay. What I want to do is I want to thank our listeners for joining us today. I hope that you found this presentation to be educational, informative. I want to especially thank Jilliene, again from Realty Mogul, for her time and valuable information. For any questions regarding crowdfunding, as you can see, Jilliene, could you go ahead and just kind of tell the listeners your contact information one more time yourself, please?
Yeah, sure. You can always find us at www.realtymogul.com. We've got a pretty extensive FAQ section and also an About Us section that you can learn more. You can email us at info@realtymogul.com, and you can call us at 877-977 And I'm more than happy to answer any additional questions. Feel free to email or call. You'll either catch someone on my team or me directly. I'm happy to meet with investors as well. So please do reach out. And again, if you have questions about crowdfunding, first trust deed investing, equity investing in real estate, or just want to hear my thoughts on where we're at in the market, I'm always happy to do it for any investor and share what I've learned and the benefit of a lot of really great real estate mentors that I've had in my career.
Great. Thank you so much, Jilliene. And as far as questions that you may have regarding self-directed IRAs, here's my information. It can be reached at mghosheh, MGHOSHEH, at theentrustgroup.com. Direct number is 310-496-4216. Feel free to call me, email me with any questions. Better yet, if you're local, my office is in LA. We're more than happy to set up a time for you as a free consultation on self-directed IRAs, what you can and cannot do, and just chat with you and try to answer any of your questions. So again, I want to thank all of our listeners and thank Jilliene for this wonderful presentation, and everyone have a great day. Thank you so much.
Thank you.
Thank you. Please stand by.